Distinguished ladies and gentlemen, a very good evening. And it is my pleasure to welcome you to this evening's event titled Made of Africa Award.
Best trading license holder across asset classes. The nominees are APT Securities and Funds, CardinalStone Securities Limited, Finmo Finance Company Limited.
The winner for this category is CardinalStone Securities Limited.
On behalf of the board and management of CardinalStone, we want to say a very big thank you to NJX. Thank you so much for the recognition. We look forward to coming next year again to get the award. Thank you.
Specifically for CardinalStone, we decided to support this initiative. The exchange, as we all know, is the key driver for capital market formation. And for us, as CardinalStone, as an emerging market leader, we want to be massively involved in partnering with Mr. Temi Popola and Oscar Oyema in building new products that would help take the exchange to its foremost position as the biggest exchange in sub-Saharan Africa. We think, and everyone here has been carefully selected, as far as we know, to also come and join in this very laudable initiative. Congratulations to the exchange and more wins ahead. Thank you very much.
I want to welcome you to the 2022 edition of the Banks and Other Financial Institutions BAFI Awards ceremony hosted by Business Day Media Limited. Market Investment Bank of the Year.
And the winner is
CardinalStone Partners Limited, Investment Manager Firm of the Year. And the winner is
CardinalStone Asset Management Limited.
Ladies and gentlemen, winner of the Stockbroking Firm of the Year Award, CardinalStone Securities Limited, Equity Research Firm of the Year. And the winner is CardinalStone Securities Limited, ladies and gentlemen.
Say thank you to my principals for supporting me, supporting that part of the business, and also to our clients who continue to be there to give us jobs to do and keep us in business.
We also thank our clients for choosing us year in, year out and giving us the opportunity to serve. I'd also like to thank our founding partners for the opportunity that they give us and the platform that they provide for us. And to all of my colleagues on stage as well, very much.
We dedicate this award to all the users of our research, internal users and external users, to all those who value quality research, objective research. Thank you very much.
Congratulations.
We should get started in the next 10 minutes, so I think we have just less than 10 minutes to get.
Because at 4:30 sharp, we'll get started. I also want to encourage those who are joining us online, if you can just drop chat below, let us know where you're joining us from. We appreciate that very much. Thank you so much. Less than.
Stockbroking Firm of the Year, second time in a row. We look forward again to coming here next year again for this award. Thank you very much.
Hello.
Yes.
Ladies and
All
gentlemen.
right, let's get started. And if I can
And it is my pleasure to welcome you to this evening's
Are we-
event.
Good evening again, everyone. You're all welcome. Happy New. Thank you very much. I hope I have your attention now. Good evening. Thank you so much for coming. We're about to get started. So if the ushers help us to invite the microphone is all right. Okay, much better. So good evening, everyone. You're all welcome again to Investors Conclave 4.0, brought to you by CardinalStone. Delighted to be moderating today's program, and it promises to be very informative. As you can imagine, today we're all about what's the outlook for 2023. So we've got the elections, we've got all the talk about potential global recession and whatnot. So we want to break all that down and get some really valuable perspective that we can use as we navigate the rest of the year. So we're delighted to have you all join us. And as you would observe as I get started, we really want to stay on schedule, and we're going to get right into the thick of things. But just before I invite our first speaker to provide some brief opening remarks, just want to welcome again our audience who are joining us online. I want to encourage you to please participate. I mentioned earlier that if you are joining us from wherever you are joining us from across the world, if you'd be kind enough to just drop a note in the chat field to let us know where you're joining us from, we'll really appreciate that. And you are very welcome. And we certainly look forward to you interacting with us and sharing your thoughts and your questions. And beyond that, I will also come back to the room to say the same thing to you all. So we hope that we can get a lot from the rich experience and exposure and assets that are in the room, that are represented in the room today. I think your views will add to the views of others, and we can take something away from today's engagement. So your open marks. The CEO of the top stockbroker on the NGX 2022. That is not just braggadocious. It is based on the facts. It is based on the information that the NGX has provided and vetted. I'd like you to please welcome Mr. Peter Omorege as he delivers a few brief opening remarks.
Thank you very much, Wale. Good evening once again. Welcome to the 4th edition of CardinalStone's Investors Conclave. This is our annual event where we try to expound on our views of on the economic outlook, key subsectors of the economy, and hold quality decisions on topical issues. Like last year, this year's event is also a hybrid one. And we're happy to have you here from your busy schedules, taking out time to join us. We appreciate you. So just a brief recap of 2022. Definitely was a challenging year globally. First of all, we had the Russian-Ukraine war, spooked economies. We had energy prices, go up across. Then we had inflation, across economies. And we had central banks try to fight that. That really was a shock to the system. Bringing it home locally, we had usual FX liquidity issues, At some point, the central bank, stopped, selling FX. And second half of the year, we saw inflation also go up aggressively locally. Central bank also hike rates. It was a very tough year. Inflation got as high as 21% and the likes. Having said all that, for us at CardinalStone, we delivered the biggest single transaction on stock exchange ever. Yeah. And of course, with your support and commitment, we ended the year as the top broker with 25% executed traded value on the exchange and 40% of the total volume. So thank you very much for your support. Thank you very much for your commitment. So into 2023, questions have been asked. Some clients are asking questions. Everybody wants to know how to position into the new year. It started on a calm note. If you look at inflation, it seems to be calming down, but the affairs of recession globally, IMF predicts, a third of economies will go into, recession this year. So those are some of the major concerns. Locally, we are looking at the elections. Everybody's wondering what to do, where to go. We have a run of a couple of questions, and I think we'll have quality discussions today. We have very revered panelists who will help us delve into some of these issues, and I believe it's very informative and educative for all of us. Attention and participation. Like Wale said, keep the questions coming, and we hope to have a very value-adding session. Thank you very much.
Thank you very much, Peter. Obviously, he was letting us know that that claim is not a flippant claim. It's based on the facts and the figures. And we're very proud of what CardinalStone and supporters that have made all this happen. So we're going to get right into it with the presentation of the day. That is CardinalStone's 2023 Outlook. And then after that, we're going to move on to a panel session where we have some very accomplished speakers who are going to give us their views from their perspectives as they represent different industries in Nigeria about what we can expect and how we navigate 2023. So without further ado, I'd like to now welcome to deliver CardinalStone's 2023 Outlook presentation. Please welcome Team Lead Banking at CardinalStone, Jerry Inebwe. A round of applause for him as he steps forward.
Thank you, Wale, for that introduction. Good evening, ladies and gentlemen, once again, and a happy new year to all of us. Okay, so while we're waiting for the slides to come up, the year is 2023. And I want to get... Hello? Okay, so I want to get a sense of the pulse. I want to get a sense of the pulse in this room. So can you please signify by the raise of your hand if you feel optimistic about this year? Optimism, 5% optimism. Okay, that looks like a large number of hands. Okay. Okay, someone says there can be blind optimism, but optimism is optimism, right? If you're pessimistic. Pessimistic. Sure, man. Pessimism. Oh, wow. Pessimistic. Okay, if you're never here nor there, I mean, optimistic, pessimistic, I'm just neutral about the year. Think about everything, elections, FX, growth, whatever it is.
I'm not sure what's wrong with the microphone, but I think it's more stable if you stay here.
So if you're neutral, and if you're online as well, you can type in how you feel. I'm optimistic, neutral, pessimistic. Okay, I think lots of hands, a lot of us are optimistic, and that's really good to know. I'll let you know what I think after the presentation. But this conversation, because I want to share with you our views for the year, and what better place to start than what's on everybody's lips, elections. You know, in a few weeks' time, 5-6 weeks, we'll be going to the polls to elect who the new president is. And in our view, we think that this election is likely to be one of the most keenly contested since 1999. In fact, we expect to see much better voter turnout than we've seen in the last 3 election cycles. But the key conversation really isn't about the elections itself, but what happens post-elections, because fortunately, according to polls, the 3 leading candidates appear to have similar pro-market tendencies. But beyond what they have put in their campaign documents, what are the issues that face them after elections? In our view, we think that they have to deal with prevailing issues of insecurity, growth issues, infrastructure. There's talk about COVID, pertinent issues that have to be dealt with. But broadly, this year, from a political sense, is likely to be a year of 2 halves. Now, the first half of the year is about every one of us getting a sense of the identity of political leadership, down from presidency even to the caliber and quality of the cabinet. And half of the next 4 years of the key issues that we're looking out for from the political side of things. Okay. Okay, so next slide, please. So with politics, like I said, the 3 candidates similar views, which means they're all looking at the same issues, the fiscal status of the country as it is at the moment. And what is it? Because we think that first and foremost, irrespective of who wins and irrespective of what they have in their campaign documents, current MTEL framework is still going to apply, because 2023 is most likely to be a transitory year for whoever wins the elections. So that said, we expect that the current MTEL would apply. And looking at it from a fiscal perspective, even just looking at the budget, we think we're doing well in the non-oil revenue side. From a non-oil revenue perspective, we think that there's capacity to boost non-oil revenue. As of November last year, based on the numbers we've seen from the budget office, November last year, we achieved over 100% of our non-oil revenue projections on a pro rata basis. Of course, mostly boosted by taxes. But even if you look at the independent revenues, the variance was just somewhere about 6 or 7%, and that's encouraging. That shows then that the area we really need to focus on as a country is oil revenues, which hasn't been doing so well. As of November, we're about 35% of projected oil revenues. And again, that's down to the impact of the subsidy burden that we have been facing as a country. Perhaps it's no surprise why they are looking at ways to phase it out. I mean, what the Minister of Finance has said and also what has been provisioned for in the budget is just 6 months subsidy provisions. So after the next 6 months, after the first 6 months, then again, they're leaving it to whoever becomes the president to have to make that decision in terms of the modalities for removing subsidy, whether it's going to be drastic or it's going to be a gradual phase out. But we believe, a gradual phase out, is the most likely possibility from that sense. But oil revenues is one area that we really, really need to look at. But the notable highlight again from the fiscal sense is the huge budget deficit, about 11.3 trillion. That's a lot. Yes, about 5% of GDP, but 11 trillion. The question that has been asked is how would it be funded? And what the federal government wants to do, they plan to do, is to get about 7 trillion of funding from domestic sources and about 3 trillion from foreign sources. Last year, as of November, over 90% of borrowings were sourced domestically. also captured ways and means, but over 90% of all the borrowings as of November last year were sourced domestically. And so we think that in 2023 as well, and also as the budget has said, we'll continue to see an increasing domestic focus, from the borrowing side. And again, you want to ask what the implications would be for the yield environment, given the maturity profile that we see. But we'll have that conversation in subsequent slides. Next, please. Or before you go to the next slide, so sorry, go back. So before you go to the next slide, they also, from the deficits leg, the questions about sustainability of the debts. You want to do 7 trillion, how sustainable is it really? And if you look at the chart, the top chart, you see what the debt service to revenue ratio has been in the last 6-7 years. As of September last year was 53%, but by November, that number had climbed to over 80%. Which shows them that if we can up our game from the revenue leg, we may see some improvement. And like I said, the subsidy is one way that can give subsidy, removal of subsidy actually gives leg room. Because if we do not have to pay the heavy subsidies, then we're able to transfer more to the federation account, and that's going to ease the debt service burden we're likely to face. So even if it climbs this year to about 83%, which we think it could, subsequent years in 2024, we expect that number begin to taper. And you also look at the charts at the bottom. I mean, some have said, oh, are we going to have a Ghana situation in Nigeria in terms of our Eurobond exposures and all that? But if you see the Eurobond maturities that we have in the next 4 years, we don't think there's a lot that elicits, concern or worry for us. Just $500 million this year and about $1.1 billion in 2025. So I think from that standpoint, things are looking okay for us. And what the government tries to do is they want to reduce our exposure in the debt mix. They want to reduce our exposure to the foreign component from about 40% to 30%. It's at 42% thereabouts, but by the end of this year, they hope to get 30%. So if you have done 90% domestic borrowing last year, and this year you also want to do significant domestic borrowing, then that should, help reduce the risk of, the exposures on the foreign currency side. Next slide, please. And so currency, this is a perennial conversation. We've always talked about this over and over and over again. And if you ask anybody, I'm sure if you ask anybody in this room, what do you expect for currency? We say a devaluation is likely. A devaluation is likely. And that's our view too, especially in the INE market. We think that the Naira is still likely to be devalued or depreciate in the INE window to somewhere around 500. In fact, we heard that some are pricing it above 500 and bidding at higher levels, actually. So that pressure is still there. But we also think from the parallel market side that if spread, the premium could actually narrow this year. And there are two reasons why we think that. One is what some have referred to as the Tompoli effect. Increasing scrutiny and security or surveillance, right, of our pipelines just to be able to enhance and boost oil production. If we're able to do that, then that leads to more, FX revenues for us, and that's a good thing from the FX side, right? And I think we've seen the numbers, we've heard the numbers, some, thousands of barrels of oil production per day have been able to come in as a result of that alone. So that's one way we're looking at it. Then the other leg is the impact of Dangote refinery. NNPC has said it, the CBN has said it, even Dangote has said it, that this could lead to, on a net basis, FX savings for us. So the impact of Dangote refinery transcends just FX alone. If you're looking at it broadly, in our view, it transcends FX alone, even growth. IMF has projected about 30 basis points growth contribution as a result of that alone. And we think that even if the government were not to remove subsidies, with Dangote refinery alone, the burden won't be as high as it is currently. For example, if you look at the pricing, right, last year, this MD of NNPC said that the pump price, without subsidies should be 410 naira per liter, right? And that is because we are using what economists would typically refer to as an imports index method of assessing it, right? But with Dangote refinery, even if Dangote is going to sell to us at the price he's going to have to export EMS, it doesn't include certain components that are already being included now, like freight and insurance. So on a net basis, we are better off as a country with it. And you're not also adding, if you bring in the informal sector, the second order effect of it, right? Where the refinery is located, the jobs that will be created around those areas, all of these suggests that, I mean, it has more positive benefits for us as a country than negative. In fact, I read the reports that even neighbors, Ghana and all that, are projecting their growth, the growth for the economy on the basis of Dangote refinery alone. So that's how much good it can actually do. So yes, we're positive, and we think that that could also ease pressures on the FX front. So for fixed income, like I said earlier, for fixed income, we think that broadly yields are going to be elevated next year. And there are three key reasons why we're looking at. There are three key points from this perspective. The first, like I mentioned, is government's aggressive borrowing. 7 trillion is a lot. Now, we're not sure how much of this would come, from ways and means, given the increasing scrutiny in that space. So we're not sure how much of it will come from ways and means, but what's obvious is that government is going to be aggressive on the domestic front. And that's more than what can be captured. If you look at the charts, apart from the first half of the year, in the second half, the maturity profile is not a lot to be able to, if you superimpose the 7 trillion domestic borrowing, you think that there's every indication that yields will go up. So yes, government's aggressive borrowing. Monetary policy also likely to remain hawkish, especially the CBN continues to, protect the currency, and then you have inflationary pressures as well that have to be dealt with. And I've also talked about the liquidity condition in the system liquidity condition. So in our view, on a broad basis, we think yields likely to be 100, 150 basis points, mostly tilted towards the long end because of government's aggressive borrowing from the bond space and maturity management, which means they probably want to issue more longer dated bond to manage their exposure. So on the long end, we think that is going to be faster, more like a bear steepening curve. So you want to play shorts, except for sometime in April where we have lots of liquidity, then portfolio managers want to take tactical exposures to durations. But beyond that, we think a broad short duration strategy is worth it this year. And for equities, we're looking at a few key themes. Elections is one of them. And yes, the market has been rallying, a couple of weeks right now. But election uncertainty still has, it still has some sort of burden, right, in the perception of the market, especially from a foreign perspective. I would think that after the elections, there's going to be more clarity, for how people perceive the overall macro and political environment, to come in. But we also think that the market broadly beyond elections will be driven by domestic participants, as we've seen in the last couple of years. In fact, the foreign guys are most likely to want to, beyond who is the president, just want to get a sense, like I said at the beginning of the presentation, to have the cabinet members, the policy thrust and direction. Can I trust this government? Can I trust the policies? Can I trust the reforms? Everything that has to do with FX and all that. They want to get more clarity than we locals. So we think most likely they'll be on the sidelines. But for locals, yes, election activities takes away some of the uncertainty. Yield dynamics, and like we said, yields likely to go up, and that could, depress valuations in the equity market space. So that leaves us having to look at the companies themselves, the sectors themselves, to determine how we play. And in our view, we think a thematic approach to investing is one way to go. So you want to look at the theme of interest rates. So I'm looking at banks, what banks are better able to take advantage of the yield environment. And even with cost of funds pressures, these banks are likely to boast resilient net interest margins, in addition to their strategies around managing the disruptions of fintech. So you want to also look at them, but exposure to interest rates is positive. And also even non-banking companies that have, like Dangote Sugar, for example, they enjoy years when the yield environment is high, so they can boost their investment income. So that's one strategy you want to look at, exposure to interest rates. Another is financial inclusion with e-Naira, with cashless policy. Telecoms is a sector that is likely to benefit because telecoms data will drive a lot of things. Fintech, payments, insurtech, everything you can think of. So for financial inclusion, you also want to look at telecoms because they're likely to benefit from that particular thing. The theme of infrastructure, government spending is still likely to continue and persist year over year as we also continue to urbanize. So you also want to look at cement companies that are able to do well. You want to look at materials companies, the paints. You also want to look at, the construction companies as well. Just putting that theme, using that theme to guide your watch list. That's something to look at. Deregulation is another way of thinking about. And that's also, of course, depends on how the subsidy conversation evolves, especially in the second half of the year. But deregulation, so if eventually we're able to achieve a deregulation of the downstream sector, then you also want to have your eyes on the companies in that space. And then commodities. You also want to look at commodities. Yes, the projections of the commodity, especially for CPO and oil prices, likely to moderate. But we live in a world that, because of geopolitical tensions, is volatile, right? It's really volatile because of geopolitical tensions. China has reopened the economy. Again, Russia-Ukraine war, we can start seeing supply chain restrictions that are able to catalyze commodity prices. So you also want to add that in your watch list. And these are the things, this is how we think, you want to focus or play in the equity space this year. So this slide just captures a summary of our views across different indicators. Like I've talked about growth, we're optimistic. We think about 3.2% GDP growth, supported to a large extent by the oil sector, because the base really last year was low. Oil production was really, really low last year. So we think that this year, oil production, I've talked about topical effect and everything they're doing on that front, like to support GDP. For MPC, we think about 100 basis points as the CBN also continues to deal with issues of inflation and FX pressures as well. Inflation 18.6% on average, and that's largely due to base effect. Largely due to base effect. So what that also means is that, it's elevated, right? The targets for the CBN is about 9 to 12%. So looking at it, 18.6%. Yes, it could be coming down, but it's still a lot, it's still high. So there's still a need to deal with the issues. Of course, mostly structural issues, but the CBN also believes that with monetary tools, it can bring down inflation. So we'll watch and see. And these are our views across everything. Thanks so much for listening. But before I go, I also want to ask the question again. How do you really feel about 2023? Are you optimistic? Show of hands. Optimistic. The hands are lower now.
No, they're up.
Okay. Great. Mo, you have 2 hands up.
He's
all right.
Sold.
Thanks so much, William.
Thank you very much. Please, a round of applause for Jerry. So Jerry would stick around to take a few questions from the room. Maybe I'll pose the first one to get everybody warmed up. So you are projecting 18.6% inflation, and I'm wondering to what extent you are considering the potential impact of the subsidy removal, which many people suggest, if not completely, to some extent, it will be done this year, and there's no doubt that that will lead to a hike in petrol prices. So have you factored that into your expectation?
Yes, we factor in the subsidy conversation in our projections for inflation. Like I said, inflation is mostly base effect. I mean, last year was a really high base, especially in the early parts of the year. It was really high base. So by the time you come towards the later half of the year, we probably see that the pace of declining inflation will not be as much. And that's because of the issue with subsidy.
Okay, thank you. So do we have any other questions from the room? I'm also going to go to the the Zoom platform to get some questions as well. But if we have any questions here, please just signify by raising up your hand. Or if you have any pushback on any of his projections or you want to interrogate them, you are free to do that as well. All right, we have a question from the front here. Please introduce yourself and get right to it. Thank you.
Thank you. Thank you so much. My name is Debo Lukambi. I was expecting to hear something around the change in currency and what people seem to be experiencing as limited supply of the naira, and which one would expect, should impact all of those other things, inflation, the exchange rates, and other indices. What would be your take on the impacts of that?
So for the change in currency, I mean, we think
limited supply.
Okay, so limited supply in currency. For the limited supply in currency, first and foremost, let's look where we're coming from and now, right? Before the redesign of the currency, the CBN said about 80% of money circulation is outside of the banking system. 80% outside of the banking system. And now, they have said, bring everything in, you just try to overhaul the entire thing. So tighten is a way of monetary policy tightening. So in addition, so basically they've achieved the goal. It's still like the CBN raising rates in terms of impact. In terms of impact, it's still as if they are raising rates at the end of the day. But limited supply, we think that if they are not able to supply because banks have said they haven't gotten, it's what's going to happen at the end of the month, because that's the deadline that was given. And the CBN has been adamant. But I believe, right, the rational thing to do would be, if there are not a lot of supplies by the end of the month, to extend the deadline. That's really the rational thing. It's a structural issue. I don't think it's deliberate. The fact that we don't have the replacement currency as at the time when all of the other currencies need to be out of the way. Right? But if they can deal with it, then that makes sense. What it now means is that if all of the old notes are out of the banking system or out of people's pockets, and people have restrictions in how much they can do on a cash basis, then the conversation, the story of financial inclusion comes.
What is, sorry, my question was, what would be the impact, right? You are assuming they will extend or they'll make more available. We not assuming. What we see now is the deadline is the deadline, and the limited supplies are the limited supplies. The assumptions, if they happen, will come later. What do you see as the impact if this is the policy that is sustained the way it is?
Just by the way, I want to also invite Philip and the head of the research team at CardinalStone to also chime in and take some of the questions.
Yeah, so if by the 31st of January, supply is limited, I think what would happen is people will be forced, and they're not changing deadlines or anything, people will be forced to do, cashless transactions. That's essentially what they want to do. That's what they want to achieve. So if by the end,
it's clearly disruptive for
yes, it's disruptive because a lot of people are still having hard time, getting used to it. There's talk about the CBN has not even done enough to, advertise or sensitize people about the thing itself in different areas. So if it's not available, it's going to be disruptive. It'll be chaos. Similar to what happened in COVID when people could not withdraw cash from banks. And,
okay.
It was rowdy.
I think Philip wants to add a few thoughts on that.
Okay, thank you very much, Jerry, for the response, and thank you, sir, for the question. We think that there is a short-term view to this, or you would rather say immediate-term view, and maybe a more extended medium-term view on potential impact. Now, given the limited supply we are seeing and the deadline that is looking around the corner, if we assume that deadline will not be shifted substantially, what that may result to is some disruptions to transactions, particularly in areas that are not as developed, right? Areas where people are not very used to digital transactions and where financial inclusion is lower. So it may sort of disrupt
transaction patterns in those places. But then in the medium to long term, once the CBN is able to respond to these challenges and as much as possible of the new currencies are pushed out, what you could expect is that by then a lot of people may have more or less learned how to more or less utilize some of those digital platforms and may boost overall digital transactions. It's likely to take, and that's what I say medium term. It's likely to boost overall digital transactions. But in addition to that, from a policy standpoint, it may lead to greater regulatory capture, because that for us was the original intention, to improve the efficacy of monetary policy. A lot of currencies were out of the system, so they were looking to bring as much of the currency, more or less as much as of the money in circulation, right, under the control of monetary policy. So that may be a more medium-term impact, but very short-term, immediate term, there may be certain disruptions, particularly in areas that are not so developed.
I also like to invite Olaolu Boboye to join them. He's the team lead macro at CardinalStone. Do we have any other questions? Okay, we have one here. We have one here. And before that, we also have a question from Zoom, and it relates to Ghana. So obviously, we have investors that are looking beyond the shores of Nigeria, and they want you to comment on the Ghana situation with respect to their bond. What, in your view, is the outlook for that asset for anyone holding it or considering investing? Very short comment on that, please.
Well, on Ghana, I see the moment they mentioned Ghana, people, I would say one thing, and I read it from a very interesting report, that one thing that is certain about 2023 is uncertainty. And for Ghana, it's very true. It's clear that there have been selective defaults, right? And what we know is that even for the domestic debts, for their domestic debt, restructuring efforts have failed, like they've postponed 3 times, right? And a lot of people have been affected by the default in the 2026 Euro bond instrument. So that is the much we know. But what is important is that negotiations, they are still trying to push negotiations through the G20 for the Euro bonds. But then there is a particular concern that is worthy of note. And that concern is that a lot of foreign institutions that invest in Ghana also invest in other African sovereigns. So they are very careful not to allow the case of Ghana become some sort of a precedent. And that may underline a hard stance on negotiations. That may lead to protracted negotiations, a lot of back and forth, right? So add to uncertainty the likelihood that there may be protracted negotiations, because those institutions would not want to sort of allow some sort of negative precedents to ensue due to this Ghana event. But it's one we are watching closely. What do we do? Well, if you are in, that's the very nature. Some of our advisors may have spoke about the risk. Now, so you knew the risk, right, before you went in, but then we think that you would have to maybe wait and see how development unfolds. Because, like I said, there's a lot of uncertainty. You will have to wait and see. So it is as data comes, we advise you as data comes up, right? Even for the Europe, there are a lot of theories. They are going to shave off face value by 30% is one. They are going to delay coupons for 3 years is another. After coupon resumes, they're going to shave off 30% of coupons. So there are a lot of things that are moving, a lot of moving parts. And that's why we say a wait and see may apply on Ghana. Right.
Yeah.
Good evening, everybody. My name is Femi Akintunde, the CEO of our family group. I have two questions. One leads to the other. There seems to be a lot of hope built around the Dangote refinery coming on stream this year. Even though the GDP contribution of oil and gas may not be as high, we're talking of around 5-6%, but the impact of oil and gas on our revenue earning and the impact on foreign exchange value is very strong. Peradventure, Dangote refinery doesn't come on stream. What happens to us? That's question one. Number two, I've heard so much about Nigeria population, 200, 250, whatever it is. But a population with a very weak purchasing power is a problem. The only way the purchasing power of an average Nigerian can begin to get back to what it used to be, two things must happen: effective spend control and good revenue generation, which can only come through effective diversification of the economic base. We all know that that will not happen overnight. It takes time. The discipline required and the political will for spend control will take some time, especially in the election year. If that doesn't happen, what do you think will happen to the economy in 2023? And why should we have optimism? Thank you.
Can I add I have a Dangote related question as well? Very brief. My name is Zila Karaiwe, and I just want to find out, there's so much optimism about the revenue potential of Dangote refinery. My understanding is that Dangote refinery is in a free trade zone, which means that there are waivers on federal, state, and local government taxes. There are no import duties, so he's not going to pay tax. The people that work there are not going to pay tax. There's no import duty, there is nothing. So why is he not? Also, the legal tender law doesn't apply. He does not have to transact in Naira, and he does not have to sell into Nigeria. So why do we all think that when he starts producing and selling, he's going to make an impact in the local market?
So, tough questions are coming. So what do you feel?
Okay, I'll start with the first question on Dangote refinery. What if it doesn't come? Is the question. And I will borrow from estimates of the IMF and the World Bank. The communication is we could gain a 30 basis points addition to overall GDP growth if Dangote refinery comes on stream. So from a GDP perspective, if you were estimating 3.2%, and you are probably factoring in Dangote refinery running for only a third of the year, so probably you could shave off a third of the contribution of the expected contribution from Dangote refinery. So you take out a third of 30 basis points. You take out a third of 30 basis points, that's about 10 basis points, right? You shave it off your GDP, right? We are expecting 3.2%. So that if we leave that off, that should be taking us to like 3.1%. Remember that oil refinery is not such a big component of GDP at the moment. So that's what we think, right? So we just go with that. But in terms of broader impacts, what you are likely to see is that conversations on subsidies may even be delayed further. There was an NNPC article I saw cited on Reuters, where they clearly stated that the discussions on subsidies is sort of closely linked to expectations that Dangote refinery will come on stream. So if that delays or doesn't come on stream, expect that it will become a tad more difficult to remove subsidies, because you're removing subsidies and you're not refining locally. It's a difficult equation to solve. And that will mean that we may see protracted FX liquidity crisis. We know we're experiencing FX liquidity crisis. Hopes are that Dangote refinery will come. The $13 billion we spend on importation of crude-related products, right? Refined crude-related products will actually go off, even though Dangote refinery will also be off-taker of our oil production, meaning that exports will be affected. It's a netting impact. But we are saying it's going to be positive. But if it doesn't happen that we expect, we continue to spend a lot on importation of refined products, and that would crowd out the limited effects that we have. So FX liquidity conditions are likely to go. Illiquidity conditions could be protracted as a result. So that is the first one. The second question.
And fiscal space will continue to be eroded because we have to keep paying the subsidies and no opportunities for spending. Because speaking to growth, I'll just paint a broad picture of what it's like. Speaking to growth and how subsidies may be impacting growth. It's not one for one, but it just gives a sense for why it only makes sense for Dangote refinery to work. Your spending this year, the projection is 3.6 trillion for subsidies. Now imagine we do not have to spend that on subsidies. We don't have to spend 3.6 trillion on subsidies. It means that when all revenues come in, we're able to transfer them to the federation account and we have more fiscal space for growth and spending. Government spending is nothing compared to the kind of spending that we need to grow the economy. It's just about 2.5% of GDP. That's not the spending you want to grow the economy with. The alternative to government spending is FDI flows, but that's only about 1.5% of GDP because they don't trust our story. They don't trust the story. So the succor comes from bank credits, which is about 23 to 25% of GDP. But that alone is not enough because credits, bank credits, mostly to large corporates. Right? This is a labor-intensive country, which means that you also need a bit of credit to SMEs and others. Yes, credit is going, but it's not the kind of credit that can lead to the growth and development of the country. So there's a lot of moving parts, right, across the different macro variables that we're looking at from this perspective.
Yeah, on Dangote refinery, I think there was a follow-up question on how are we even sure Dangote will sell in Naira. To that, I would say we are assuming that Dangote will sell in Naira. It's not the first time. We are assuming, that's the assumption, our base assumptions for that we sell to domestic institutions in Naira. And it is not the first time we are having refinery operations in Nigeria. Once upon a time, Port Harcourt's capital refineries, they were working and they were selling. All right, but what we think is that they are likely to adopt a similar pricing or a similar model of transactions like used for gas. If you look at the Dangote group as a whole, you find that most of the group, or they rely heavily on gas in their energy mix. And those gas, the cost is actually, we usually say it is indexed to dollar but priced in Naira, right? So the dollar is influenced by changes in dollar values, but for actual payments is in Naira. So it's indexed to the dollar, but then paid in Naira. So we think that given that there's been a relationship on energy pricing between the Dangote group as a whole and NNPC plus other stakeholders within the space, we think that that relationship is likely to continue. That's what we think. Then in terms of other things that support our optimism, we know that they operate in the free trade zone, etc. But then once they come on stream, we are also likely to see savings on other ancillary cost fronts. For instance, things like freight costs that typically add to the landing costs of PMS may actually give way, right? So, there will not be need for freight costs, or maybe some other insurances that are linked to the transportation of those refined products from country X down to Nigeria. So we think that there will be some sort of cost savings on those fronts, and that may overall lead to net benefits from the operations of the of the refinery.
Thank you very much. We are going to have to break the questions for now because as we all know, we still have our panelists coming on board. They will also chime in, share their perspective, and we also want to give you the opportunity to also contribute at that point. So we're going to pause on the questions for now as we move on with the program. So on that note, I'd like you to please put your hands together for them. They were able to take some of those tough questions, and there are certainly more to come. Right, thank you very much. So before we move on to the panel, and we are also trying to be very mindful of the time. We know that some of us are going over the bridge. So we'd like to keep this moving as quickly as possible. And we also are very mindful of the schedule of our panelists. Okay. All right. Okay, so I've just been informed that the next person to come forward now needs about a 5 minute, needs 5 minutes to be ready. So I think on that note, we can just perhaps get maybe one or two more perspective. Mohammed, I know you wanted to share some thoughts. So let me just allow you to speak while we wait for this person to be ready.
I don't, okay. Yeah, so, I want to reply to Zill's question. Very, very valid points. And to be honest, Dangote is a commercial business. There's no way he would leave his business. We all understand the funding structure for that business. There's a lot of FX is layered. He's borrowed a lot of money. So his first focus would even be to honor his obligations. So it's not just producing petrol or selling petrol to Nigeria. It's an entity. He's owing a lot of debt. So he's going to run it like a proper commercial business. Petrol will be sold at commercial price. We already, and you can see most of the good thing is most of the leading contestants are already hinting on removing subsidy because that's the only way to go. He's going to sell and he's already in a free zone. He has an alternative to ship his products out. But his first obligation is to his creditors. He has to pay his debts. Thank you very much. I just want to clear that.
So it's a fair point, something to watch. And in fact, I guess the jury is still out on the impact of the Dangote refinery. I was at an event earlier today, and I think some people are still not sold on the impact. There is a view that while we may gain in terms of the FX savings from importing petrol, we may lose on the FX revenues relating to the production of crude. So we'll see how things shape up. Well, like I said, the jury is still out. But we certainly need it to happen this year. Do we have Temilayo ready now? Is she ready? Okay. You said we want to take a brief musical interlude before we just move on to the panel session. And we have performing for us today, Temilayo. I believe she is ready. You're not quite. All right, so I think we can now give her the applause. She's coming forward now. Please, a round of applause for her. Thank you very much, Temilayo. You know, I was just thinking that in the light of the Jackpot syndrome and what it has done for Nigeria, it's always great to see when the young talent are still here, isn't it? So another round of applause for her. Thank you so much. All right, so now we're moving on to another headline of this evening's event, and that is our panel session, where we are going to be interrogating the views of different people who are representing different economic sectors and just getting a sense of how they see 2023. And certainly I would be learning a lot from them. So I'd like to now to just welcome them very quickly to the front of the room. I start with the General Manager, Corporate Treasury at MTN Nigeria. Please welcome Mr. Ishmael Nwakocha. Thank you very much. We also have joining us today the Executive Director, Treasury and International Banking at First Bank, Mr. Ini Ebong. And we have representing the Managing Director and CEO of Flour Mills, Mr. Omoboye Olusoya, who unfortunately couldn't make it this evening, but he is ably represented by Director Group Strategy and Stakeholder Relations at Flour Mills. Please welcome Mr. Sadiq Usman. And last but certainly not least, we have from the Lagos Business School, Dr. Ikechukwu Kelikumi. Please a round of applause for him as he comes. And I have the pleasure of moderating this session, so I'm going to take my seat there. And just to reiterate again, for those who are joining us virtually, we look forward to receiving your questions and comments and posing them to our speakers or our panelists. So let's get started. Can we have an extra microphone? Okay, so I think a good place to start is just to get a feel of how each of our panelists are seeing 2023 in the context of their sectors. And I would like to hear about the agriculture sector, which of course is represented by Flour Mills. 2022 was obviously a very tough year. The floods was certainly one of the key events that impacted agriculture. But beyond that, we continue to hear about this whole dynamic of production being impacted by several factors. So I would like to hear from you, Sadiq, in terms of how you see that sector playing out in 2023. What are your biggest concerns? Where do you see the opportunity, especially in the context of a new administration in Nigeria?
Thank you very much. Yes, can you hear me? Hi. Good evening, and thank you very much for having me. 2022 wasn't particularly bad. Actually, it's quite nuanced. Obviously, we as Flour Mills, we play both in the food and in terms of the summary, I would say net, it was positive. It started off with a very challenging year, if you recall, the conflict for which we're still seeing the effects of today. We thought the fertilizer business that we had was going to be very challenged. It's actually turned out to be a record year for the business, partly because of some internal decisions we took in terms of procurement. And raw material availability was a challenge for half the year. We expect 2023 to be better as things stabilize regarding the conflict. Many countries now, Nigeria was 100% dependent on Russia. space, obviously. Fertilizer is still a central government procurement. So that the watching to the second part, new administration and the change in policy. You know, for the last 6 years or 7 years, we've had the Presidential Fertilizer Initiative, which has the Sovereign Wealth Fund playing a prominent role in procurement. So for most of us, we're hoping that change because it will bring a lot of disruption into the space. And there's a action that has also come to the fertilizer space, including some of the big international players such as OCP. So we're looking forward to that. Last year, also the agri space, just to fit, we saw the disruption in terms of the floods. Even though it's good to acknowledge that in rice and in some agricultural commodities, we've seen a good improvement over the last couple of years in terms of production. So the flood actually came at a bad time and it was quite disruptive, but it affected some of us who are in the food business. It affected the consumer in a positive way, in that with wheat prices increasing as a result of the conflict, there was consumer switching that happened up until the time of the flood. The harvest this year has been generally good.
You mean last year?
No, it's still the harvest.
Okay, it's the harvest season right now.
November, yes.
Gotcha.
So the harvest season is sort of coming to an end in the next few weeks. It's been generally good across all crops, despite the floods that we witnessed. Maize, soybean, seeing strong results. So I don't know how Nigeria is managing to do it.
Sorry, please go ahead.
Despite all the insecurity, I don't know how we're managing.
It's amazing, eh?
It's amazing. I'm not really sure I understand what's going on myself. But despite all the insecurity, the floods, production is still, maize prices, which was the miracle. Throughout last year, maize prices were falling, even in the midst of it's remarkable, really. So
does that reflect significant supply, or is still something you can't really put a finger on?
I think some credit must go to both the farmers and the government. I think there's been an improvement by what metrics you judge. There's been an improvement in agricultural production over the last couple of years. In some commodities like maize, rice, certainly there's been an improvement. We've also seen, because of the shutting of the borders at some point, there was also less commodities going across the border. Even though now with things happening regarding the exchange rate, it comes into play because the CFA is a much more stable currency, obviously. So we've seen on the food side, it was probably a challenge calendar Q2 and Q3 in particular on the food side, because consumer demand was falling, particularly for wheat-based products such as ours, because of global wheat prices. But we've seen a stabilization of wheat prices, even globally. We're hoping that the conflict, obviously, in the Baltics does not spread beyond what it is today. Clearly, some grain, it's also making its way out of the Baltics. So we expect that we should end the year very strongly.
So you're very optimistic and positive about this year.
Ending the year, but beyond ending the year, I'm not so optimistic because the elections, I think, could be a disruptive factor, possibly even more than COVID for us, because COVID wasn't particularly disruptive to the food industry, right? We had a very good COVID.
Very awkward, huh?
It was good for us. It could be very disruptive. The elections could be disruptive. Such as the census could also be disruptive.
Right. But if I can quickly come back to the flood, and you can just clarify this point, because I mean, when we see the pictures and we see the saturation of the land,
I'm not an agri expert, but I get a sense that the impact could linger. But maybe you can speak to that in terms of how it could have completely damaged the soil and so forth.
Well, the floods actually,
even after the waters recede, I impact that. I
okay,
think that
so
could be
okay. So the immediate impact really depends on where the floods happened, right? So the floods, if you look at it, it happened mainly around two major river systems, so the Niger and the Benue in particular, correct, and going all the way down to the Niger Delta. There were some specific parts of the north, big grain production belts like Jigar, that suffered the flood. But they suffered the flood, I think, was it in the month of September, October, where those who planted early had already started to harvest. So it wasn't as significant. It also depends on where exactly, because if you see floods in urban areas, that has very little impact in agriculture, right? Now, in terms of the longer term effects that you're talking about, yes, there's a tendency that the floods could maybe wash away the topsoil or reduce the fertility of the soil in the short term, but it depends on the crop as well. So if it's, for instance, we that are in the business of sugarcane on the banks of River Niger in our farm in Sunti, when we had the flood 2 years ago, fortunately we were insulated this year. I think it's a miracle that we were insulated because for the last 5 years, and don't believe anyone that tells you climate change isn't real. For the last 5 years, we've had 2 1 in a 100-year flooding event. Flooded 2 years ago, and we managed to avoid any flooding this year. But what you tend to notice with things like sugarcane is there's not only an impact on the crop that's on the ground, but there's a 2-year lag in terms of the impact on the soil. I don't know what it is like for rice and soybean, but I would say those are the 3 crops that would have tended to be affected based on our planting season.
But overall, you would say that the Nigerian agriculture sector has moved on from the impact of that flood.
Oh, yes.
But the big question is whether or not it will happen again.
Correct. Well, it is going to happen. It is going to be a continuous.
Or when?
It is going to happen with regularity now for different reasons. Which
thank you very much for your insight. Let's move on to another sector now. And as I speak to Ini, financial services has obviously a very good view of everything. And so we could talk about just how you see the economy in general. But more specifically, if you can just speak to the treasury related aspects of banking and how you see the dynamics playing out this year. Because clearly we have many people in the room that invested in fixed income and fixed income related securities. And of course, there's also the issue about the Forex.
Okay, good afternoon, everyone, and thank you for having me here. I think for the last couple of years, we've been operating under an unorthodox monetary policy regime. And that's been exacerbated by the fiscal position of Nigeria. Now, I would say when I look at 2023, I'm a lot more optimistic. And I'm optimistic because I see signs that the central bank is unwinding this unorthodox monetary policy regime. And a couple of levers are driving that. So we've recently seen that we're restoring, well, there's improvement on the fiscal side. So oil production levels are coming back up. So hopefully we start to benefit from the high oil prices. So government starts to fix its revenue problem. And then perhaps that reduces the size of deficit it needs. Government needs to borrow this year. We've seen the size of the deficit. Given the state of global markets, dollar interest rates, I don't expect the government to go into the Eurobond markets. We simply can't afford it. So that means we're going to borrow domestically. Now, we've seen signs that the central bank is starting a path towards normalization of interest rates. So we've seen the monetary policy bias change. interest rates are moving up and encouraging that. I've always believed Nigeria is a double-digit interest rate environment. We're a mid-teen environment. So having Naira interest rates in single digits like we've had for the last couple of years is not natural for the state of our financial economy. So interest rates will rise. More importantly, this debate about securitization of the ways and means is happening. Let's not get into the details of what it's been spent on or whatever, but we're putting our fiscal affairs in order. And once we securitize that, and this debt leaves the central bank's balance sheet, then that truly gives the central bank, in my opinion, the latitude to unwind unorthodox monetary policy. So by extension, this excessive CRR regime and all of that perhaps starts to run down. So we then start to have much more natural monetary policy. We've also seen some movement on the foreign exchange rate. The central bank has moved the official rate in its own way, from 420, 430, we're now about 460, we're rising. Is that where we need to be? Probably not. But certainly we can't afford to have such a disparity between the official and the parallel markets. It's just fueling way too much speculation. And you all know it's human nature. If there's one market where something is sold at 5 Naira, and there's another market where it's sold at 15 Naira, we will all look to buy at 5 and sell at 15. It's human nature. So we've got to deal with that. So we strip out some of the speculation. So I see a number of things that suggest that things start to normalize. Now, don't get me wrong, there's no silver bullet. Because of the nature of policies we've operated under for the last couple of years, it's going to be difficult to unwind and normalize. But I think that that pathway has started. The good thing, and it's been pointed out by the team that presented, all the political actors appear to be saying the right things. As it relates to market operations, they seem to all be saying the right pro-market things. So it suggests that there will be more support for policy measures along those lines. That's not what we've had for the last couple of years. So I think more positive. I think a lot more flexibility in the exchange rate. I think a higher rate environment. I think more normalized monetary policy and unwinding of this excessive CRR and so on and so forth. So we could look to a much more interesting macro environment from a market's perspective.
But specifically, what does all that mean for yields, in your opinion, especially for domestic debts? Do you think that we're still going to go north from where we are?
I said that already, interest rates are going up.
Okay.
Guys,
how significant though?
Well, look, like I said before, Nigeria is a mid-teen interest rate environment. We are not a single-digit rate environment. We're not. So rates will rise. I think that's clear.
And for the currency, obviously, normalization, I imagine, means some weakness in one of those markets, clearly.
Well, I mean, the official rate is 430. The parallel market rate is north of 700. Late last year, we almost touched 900, and we're all talking about 1,000, right? But that's largely because there's so much distortion in the key macroeconomic variables. Interest rates are in single digits. Inflation is 22. So certainly there's a lot of imbalance. Now, if I knew where exactly the currency would land, I'd be a very rich man, right? I don't. But I can tell you that we certainly need some adjustment. Now, the amount of adjustment required is a function of how we deal with the other variables. I mean, the corporates amongst us won't agree. I'm pretty sure they're all happy with the current rate environment, but the investors here will know that having T-bill rates at 7, 8, 9% doesn't work. And it's not right. It's not in balance. So interest rates need to move. If interest rates move enough, then the amount of currency adjustment required reduces. Should it be at 700? I doubt it. because I believe there's a very serious speculative bent in there. But
Right.
certainly we will see some weakness, but it depends on how the central bank manages the other adjustments along time. It's not one thing. It's not just, devaluing. I can put it to you, devalue without dealing with the other things, then you'll just see the parallel market move again and we start chasing a falling knife.
Got it. Got it. Thank you very much. Okay, so let's hear from the telco. Ishmael, your thoughts on that space and how that is likely to evolve. Clearly, many have suggested that data is the base. Now you've got to move up from there. Many are also saying that telcos have become infrastructure companies that you build all kinds of businesses on. What's the future of your space in 2023, in your view?
Okay, good evening, and thanks for inviting me. 2023, if I could answer that question with one sentence, I guess I'll be richer than any. I think for us, 2023, we are in a closed period and Temi is here looking at me, so I dare not say anything, otherwise I'll be going to jail. I think for us, for 2022 was a year we took some bold decision. Bold decision in paying about $290 million for the 5G license. And also going into elections, And when I look back 21 years behind, we had paid $285 million for a GSM license coming out of military rule. So we are really a sexy company and very, very bold at that. So I think for us, 2022 was an exciting year. 2023 is going to be a year filled with a lot of challenges and mispriced opportunity. And I guess one word that can take us through that period will be if we continue to be bold in terms of our investments and be resilient. MTN Nigeria is the largest telco company with infrastructure in Europe, Middle East, and Africa. MTN Nigeria. Because we build fiber for transmission, we put 2 generators in every of our site. We've got a large set of investment sittings in different parts of the country, but paid and owned by the company. So we're not a portfolio company. So for us, if you take a cue from what my group CEO says, that we believe that everybody deserves the benefit of a modern connected world. This is the time we have to show that we can put the infrastructure, because things will turn around. And we believe that, look, this is the worst it's going to get in terms of whether you look at it from political angle or whatever. If you take a look at the 3 gentlemen who seem to be the front contenders, we believe that any one of them can get us better than where we are today. That is the base. Then this is the time to invest in Nigeria, because when the curve turns, you need capacity to carry the economy. We're dealing with COVID now. We're dealing with areas where, there's sections in Nigeria where 30 million people get connected to only our network, and that is all they know. So some people wake up in the morning, if they can't make a call, or they don't have airtime to make a call or even data to connect and talk, you are less than a human being. So, and that's where we are venturing into areas like the fintech, because we believe that no human being should exist without access to financial services. That is dignity we are restoring in that space. We have about close to 150 million people today, and you only have about 40 million bank accounts. The magic to solve that is agents banking, which people like the First Bank is leading. It's device penetration to the woman in the village for them to be able to conduct simple banking services without carrying the large fixed cost. I mean, I told you a couple of people who were listening to me yesterday about that even our banking halls now will become museums. You understand? There's a time banks used to pride themselves. Okay, I have 4 branches on Awolo Road. Today, those branches, as far as you are concerned, some people have not been to the branch for the past 5 years. That is enabled by technology. And you understand one thing, that it is critical for us to gain access towards buying those equipment. So you're carrying heavy transmission, you are providing services that connect bank branches. We are even a carrier of carrier, so it means we provide transmission services and carrier services for other telcos. So that's how much we're embedded in. So that's why we say in 2023, there are challenges and there are also opportunities, but we'll continue to invest and continue to drive that process going forward. Thank you.
The point you're making about your investments is very interesting, because we've seen some businesses pivot in very interesting ways. The one that comes to my mind immediately is Microsoft. And I'm just wondering, what's the future of MTN as a telco? It may not necessarily be a full pivot, but perhaps the model changes to the point, like I mentioned, you are an infrastructure business that is providing a service to so many others. I would just like to hear very briefly your thoughts on that.
So if you follow our brand, we've migrated from a telco company to a telco company, technology company. So we're playing all through the gamuts of ICT. Today, we're offering broadband services through our FBB solutions. So we've got 4G, 5G in that area, providing connectivity. We are working with hyperscalers like the Microsoft and all those people. Our job is to democratize their services to the SME, so that SMEs don't need to own servers. You understand? So that in the new world and in the fourth revolution that you all know about, need access to those basic things. Having servers, having contact centers, those things have just become basics. You understand? Having access to connectivity, fiber to the office, all those things, they've just become the base. So as a technology company, we're now finding ourselves playing in the digital services, by enabling people to carry out their day-to-day life service. So there is no day you wake up, you don't use any of our services. That's one. We're also playing the financial services, where we are aiding financial inclusion, helping banking to penetrate to the last end of the mile, so that when money becomes virtual, like where the central bank is heading to now, velocity is magnified by that technology. And lastly, for us, we will still continue to do our core services, because we still need to provide data, voice, and all those kind of things. So the model is changing, the attention is changing, and we are metamorphosing into a proper technology company. Thank you.
Sounds very interesting. Thank you very much for that. Okay, so let me go to Doctor now. Doctor, you are not playing in one of these huge sectors, but you obviously will have some perspective on me. So I would just like you to speak to how you see 2023 evolving, and if peradventure you have any interesting thoughts on human capital development, it will be interesting to hear that too.
Go ahead. So thank you very much and good evening. Thank you for having me. Now, question you is really clear. If you look at 2023, the first speaker talked about optimism and pessimism. I actually will go with, I'll be flexible on this. 2023 is a year that I would just describe as a disruptive year, where we have two sectors. The telcos, the MTNs of this world, just like what you said, your block are suddenly becoming necessary. So the product companies like MTN has suddenly become a necessity. And in a year when we are moving towards a currency change, in a year where the central bank is coming up with another revolution, which will probably aid digitization very fast, we're going to have new emerging companies spring up in the year 2023. So two sectors that will be beneficiaries of this revolution is those in the ICT sector and the banking sector. So you're going to have, like he said, we're going to move towards, we're moving away from the corporate banking to retail banking, to agency banking. So there's going to be a revolution in those two sectors. I also play in the agricultural sector. I am the director of the agribusiness program at the Lagos Business School. And we've been grooming and raising people in that space, in the agribusiness space. Now, if you look at the data, the structure of the Nigerian economy, you will see that the top sectors contributing to Nigerian GDP is crop agriculture. The first thing you will see is agriculture. The second thing you will see is crop production. Now, interestingly, that sector contributes more than, I think, about 29% to Nigerians' GDP. Now, interestingly, the sector is such that it's a very volatile sector. I didn't quite agree when he said, when he was looking at optimism in that sector. It's a sector that is currently growing at 1.2%, even though it is contributing, is the major sector contributing to Nigerians' GDP. And interestingly, whatever that sector is, when you look at crop production, 2% of what is lost to post-harvest losses. So if you move across the agrarian states in Nigeria, you will discover that the big-time farmers are actually trading off their farms. They're putting up their farms for sales. So it tells you that something is not right. Insecurity is actually pushing farmers. I know. Insecurity is now, again, yes, it's a big-time farmer, but big-time farmers constitute about 20%. You have 80% smallholder farmers, more than 80% smallholder farmers. Now, what is hitting them? What is actually hitting them today is insecurity. The communities have become volatile. So you don't want to plant, somebody will harvest it. You don't want to plant, and you don't even have the knowledge of the soil and what you're doing. So there are lots of issues surrounding agriculture. Even when you throw in fertilizer into those places, you cannot. I have a farm. I have a palm plantation that I have not been able to enter. Each time I visit that village, the villagers will tell me not to enter. They'll guy you place your farm. Yes, you'll be kidnapped. Don't go into that farm. And I also have farms in Ekpe where we've not visited, we're trying to sell off the farm because of insecurity. So there's a problem that the government must address in 2023, which is more of insecurity. Again, when you look at, if you look at our farms, if you look at one of the products that he mentioned, he talked about rice. And when you go to all the hotels, the major hotels in Nigeria, and you take rice there, the rice you're taking is not local rice, it's imported rice. When you go to a big time retail outlets, you will see all kinds of branding. The rice has been branded. Now this rice they are branding is actually not local rice, it's foreign rice. But then you now ask, how is this rice coming into Nigeria, given that there's an embargo, there's a ban on this rice entering Nigeria? So it tells you that the structure of our market must actually change. If we must do, again, the difference between the local and foreign rice is about 5,000 naira. So it tells you something is not right. If we have pushed in a lot through the Anchor Borrower scheme, through activities of NISRA, why is it that we're not having a boom, which will take down the cost of rice? So something is not working right there.
Thank you very much for your insights. Yes, I think they deserve a round of applause. And I don't want to I don't want to monopolize this conversation, so I want to open it up to the audience as quickly as possible, because we also want to make sure that we can get you all out of here in good time. And again, I want to reiterate that those who are joining us virtually can also type in their questions. I want to appeal to you that if you had typed in a question earlier, please type in it again. For some reason, I may have missed some questions that you may have typed in earlier. So, does anyone have any questions in the room before I go back to my panelists? Okay, so if not at this time, let's talk about investments and opportunities in that space. So coming back to you, Sadiq, first of all, I'd like to hear clearly from Flour Mills in terms of your investment plans for 2023. Are you looking to invest more? Are you looking to consolidate? And if so, what opportunities are you looking to exploit?
Thank you very much, Wally. Some interesting perspectives from the professor in terms of we that are practitioners on the field. I think we have a slightly different perspective anyway, particularly on rice. Even though we're not in the value chain, but we'll be glad to engage with you further. In terms of investment, what I'll say is 2020. I think it was aimed at. It's for many corporates. It's going to, maybe except for MTN. MTN is sounding very bullish.
They're bullish. They are seeing the
corporates. It's a wait and see. I think it's a big wait and see. I think for some of us, we're as old as Nigeria itself, Flour Mills. I don't think it's going to stop us from doing anything that we intended to do for this year, whatever is going to happen in the political space. Where the big opportunities, perhaps maybe that's where this question is leading to. For me, I see the big opportunities in a shrinking consumer wallet, more on value commodities increasingly. I'm sure many people in this room would not like to hear that, but the sachetization of the Nigerian economy is going to continue at pace. We're not interested in the hotels, but we're interested in people in the hinterland. And I think one of the things maybe that trends over the last couple of years, I was speaking to Michael about this in terms of the consumer, the shrinking consumer wallet, which we all see. But when you look at corporate performance in the context of that, clearly, I think there's a understanding of the informal economy that is missing. And it needs to get a little bit more nuanced. And because I think there's significant untapped opportunity in that informal economy to make it more formal. And so where are the big opportunities? For us, the big opportunities we see is in terms of deepening our consumer business. Obviously, we've been having this transition from a B2B to a B2C business, because that's where the margins are, which is sort of a tautology when you turn it on its head. The margins are really in the products that are going to the poorer, not in the products that are coming to the richer consumers. So watch this space. We're under a closed period as well with our Q3. So we're going to have some product launches, I think, in the coming couple of weeks. Very exciting new products that are coming to the market that are targeting those consumers. We'll continue to invest in new product categories. The really exciting part to speak to, what the professor spoke about, and as well as MTN. I think the real disruptive space that's coming in the industry is on distribution and route to market. There's some very exciting players that have come into the space over the last 18 months to 2 years. They raised significant amounts of money, maybe from CardinalStone and the likes. And they're looking to disrupt that path from factory to consumer. Don't want to mention names so that I'm not singling anybody out, but I think that's going to be really interesting in terms of the technology that's going into that space, trying to understand the consumer, trying to anticipate the needs of the consumer, trying to not take advantage, trying to leverage on the supply chain inefficiencies that we have and the infrastructural inefficiencies that we have in the country. So I think that's one space that is very ripe for disruption, and I can see the start of something very exciting starting 2023, the route to market.
Thank you. Thank you for your insights. Ini, I want to come back to you, and not so much to talk about opportunities now, but just to assess the market conditions a little bit, especially in the context of monetary policy. So I believe my friends at CardinalStone have given me some data here that suggests that the central bank's CRR debit has exceeded over 10 trillion in the last 3 years. What, in your view, could be the long-run or long-term implications for the banking sector? You talked about normalization in the short to medium term, but what, in your view, are the implications of that policy right now?
Okay. Well, the first thing, the obvious thing is the financial impact on the performance of banks. 10 trillion, even at a 10% interest rate, you know what that means to additional revenues to the banking sector. So for those of you that buy bank stocks, it's straightforward, right? But beyond the aggregate amount of CRR that is taken, I think the impact of other administrative policies that have come about due to the unorthodox policy bias of the central bank have had a lot of impact on banks, to the extent that it's made it very difficult for normalized day-to-day operations. So liquidity management, just your ability to gap the dealing with the other policies in place to deal with purchasing foreign exchange at the auction and so many things that made it very disruptive. So the core business of banking, which is focusing on actual lending, has become extremely hard. Quite frankly, smaller banks would have struggled. Tier 1 banks like ourselves, because we have the size and breadth of balance sheet, it's made it easier. You pointed out earlier, I see us moving to the next phase of evolution in financial services, and that's moving towards true real retail consumer lending. That's where we're going. The likes of flour mills, MTN will always be banked. Corporate banking, it will always happen. In fact, today, the likes of CardinalStone are disintermediating banks. Everybody or anybody is issuing commercial paper now. So you don't even need me as a bank if you're a blue chip corporate. So the real battle or the real future is in consumer lending, true retail lending. And banks like ourselves and a few others have started to focus on that space. And we're deploying technology, we're deploying resources against that as we expand that, because that's where margins are. So CRR has been restrictive. There has been a huge financial impact, but I truly believe we will see the end of that soon. It's very important, this discussion on securitization, because once that 22 trillion leaves the central bank's balance sheet, by extension, the CRR will leave as well, or will be relieved, because whether the central bank chooses to issue, or the government, sorry, chooses to issue these securities in the market directly, is the same investor base whose funds are either in banks or other assets that will buy them, and by extension, the central bank will refund CRR, or if the central bank chooses to use some of the CRR or excess CRR we already have with them as mandatory investments, net it will reduce, relieve some of that pressure, and then hopefully allow the central bank operate in a much more normalized way. And then that allows us drive normal financial intermediation. So that's what we see.
Thank you. Going back into the room, I do see everyone back there. So can someone please get a microphone to the gentleman to the right of the room? Okay, you need a microphone. Okay. Oh, good evening. My name is Bola Oluwasegun. I work for the BUA Group. You've mentioned the interest rate regime, rising, and how double digits, we should be in a double digits regime, right? And on the same note, you've also said you want to improve consumer lending, right? At a double digits interest rate, which means cost of borrowing is higher for both consumers and corporates, right? How does that affect the economy? Okay. Do you mind if we take another question before we have you respond to that?
Good evening. My name is Hade Brown. I work for Alpha Morgan. You need to drill down to explain further on the impact and implications of the CRR from investor's point of view. Thank you so much.
From an investor's point of view, when you say investor in banks, or just an investor in the business environment?
Maybe you can take it from the banking point of view. As
Thank you.
operator, yeah.
All right. Okay. Before we go to you, Amy, please. Yep.
This one. If you look at
so during periods of high inflation, when the economy is overheated, the central bank actually invokes a kind of policy that we actually class as a contractionary monetary policy. So when we're looking at an interest rate, monetary policy rate of 16.5% and a CRR of 32.5%, tells you that the central bank is actually using that policy to fight inflation. The only challenge we have is that when we do that, the rates will go up. And as rates are going up, it becomes difficult for the investors to borrow from the banking sector, thereby stifling. Now, the only challenge here is that the inflation that the central bank is fighting is actually not linked to monetary policy and money supply. It's actually linked to structural rigidities in our markets. For example, we're looking at December, January, and we're seeing the petrol queues and the kind of inflation, the kind of price volatility that the petrol queues, the transporters have raised their fares, the commercial retail sellers have raised their fares. So we're looking at this micro level, we're actually triggering inflation. And that's not, the central bank can actually not fight that. You need fiscal policy. The kind of inflation that we're seeing, because structural, largely, the private sector will actually suffer. Again, when you add, because there's something we need to add to this, when you're looking at that debt profile, the country's debt profile, the government is borrowing from the domestic market. Every time the government borrows, the government actually triggers another kind of problem. Government borrowing tends to crowd out private sector investment. And all of this puts pressure on investors that are going to invest in the economy. Thank you.
Thank you very much. If you want to
respond more specifically to the points he made.
Okay. I think Doctor kind of outlined the answer to your question. The reality is, in a very high inflationary environment, our interest rates can't be low, and it just can't. We have to deal with inflation first and bring down inflation. That's why when you look at more developed economies, they are obsessed with keeping inflation low. That's what brings down interest rates. So whether it is structural problems, whether it is through fiscal expansion, whatever it is, the central bank and the fiscal authorities need to work in sync to bring this down. And it's not impossible. And if you think back to it, some years ago, Nigeria has brought inflation down to, I think we got to about 10, 9 once. We've gotten down to single digit just once, but we weren't able to sustain or maintain it at that level. That is the fundamental thing that must happen. That's the first thing. That brings down aggregate interest rates to a more manageable level. Now, you then have to look at the credit spectrum. Today, yes, I will tell you that we're in my opinion, we're a mid-teen, a double-digit interest rate environment. But that's the government curve, right? Which should be the risk-free rate in quotes. But then you've got the credit spreads on top of that. I'm sure my friend sitting beside me here doesn't borrow in the 20s, right? But there are corporates here that we will lend to 21%, 22%, 24%. And it keeps going. At the tail end of the spectrum, at the retail consumer who is borrowing unsecured today, some of them are borrowing at 60% annualized, 5% a month, right? And that happens everywhere in the world. I'm pretty sure some of us over here have foreign credit cards, right? Your average credit card abroad, you're probably paying 39% in US dollars. So it depends on where you are on the credit spectrum. So that will happen. But the critical thing is we must bring down inflation. And for that to happen, the fiscal authorities and the monetary authorities must be in sync. That hasn't happened for a while, right? And then we need to deal with that. On the second question around the impact of CRR, I'm not so sure I understand the question, but when you have excessive CRR, what is CRR? Basically, the government says for every deposit you raise, we take some proportion and sterilize it. Now, on paper, it's 32.5. The effective CRR today is closer to 40%. So that means for every 100 naira we take, 40 naira sits in the central bank. So I've only got 60 naira to work with. Of the 60 naira left, I have to maintain liquidity ratios. So that means I need to take, I need to have another 40 naira worth of government securities, right? So when you layer all of that, what is left to actually work with or to lend is actually quite small, right? So that's why it's inimical to banks. And that's why it constrains a lot of what we have to do. Beyond that, you also have to look at the capacity of the economy. I've also posited that Nigeria as a nation is underleveraged, right? And which is why monetary policy in some way is ineffective, because by raising rates and doing all that, because we're
when you say as a nation, you mean the people?
No, the economy.
The economy, okay, the economy.
The economy. The people, not government. That's the people, business, consumers. So we raise rates, it doesn't impact anybody here, right? Because we're under leverage. How much personal debt do we all have, right? Relative to more advanced economies where leverage, right, is much higher, which again gives you the capacity to spend, consume, and all of that. So it's a stage of evolution in our financial market development. It will come, but the key is you get inflation down, get rates down, expand the financial market, which is why we're driving financial inclusion, get more people into the financial net, get more people borrowing, get more consumer finance out there, and then that's what drives all the growth and everything.
Yes, before you drop the mic, I have one more question for you, and this is just Yeah. And I wanted to hear your thoughts about what this could signal. I think that there's a bank that is looking to issue a bond at 18%. And I'm wondering, what does that tell us about where the market is at for corporate issuers? Do you think that there is a sense that we've hit the peak of rates? How do you read that news? Or do you think potentially this bank is just simply testing the market? How do you view that?
Well, that bank is certainly not my bank. I don't believe we've hit the peak, right? Because, like I said before, I think the central bank is on a path towards normal monetary policy. So there's going to be a lot of flux. Now, where do we land at the end of that process? Does government securities will be at 18%? Maybe, maybe not. I'm not sure. But you think of the stricture under which we've operated for the last three years or thereabouts, it's very difficult to just unwind peak. I think the process has just started, and there will be some peaks, some trials, then we'll settle.
Okay. Unfortunately, it's almost 6:30 now, and we have to wind this down. So I'd like you to please put your hands together for our panelists. I think for their insights, you still have an opportunity to engage with them right after this event. So please take advantage of that if you would like to ask them any specific questions. But until that ends our panel session, and I'd like to invite Mugabe to give some closing remarks and I believe also to give us some gifts.
Thank you very much. My is closing remarks. Yes, it's just to panelists for this invitation. It's been interactive, open display here, and the level of knowledge you shared with us. Thank you very much. We also give back all of you. Elections, we also add monetary benefits, but now we think you just need good parts. Thank you much. Yeah. Thank you, sir. Thank you. Yeah. Bring on. Yeah. Thank you. Thank you. Just move closer. Yeah, okay. Thank you so much. Great, thank you. Great.
Join it. It's as no. Good evening, everyone, and thank you very much for coming by for this event. This is in the series of our annual investor conclave. It's the event we normally use to start the year. And
as we prepare for the beginning of the year, or as we prepare for the year at the beginning of the year, I normally will use my Christmas break to do my own preparation. And in the last decade, there is a documentary I typically watch over the Christmas break. It's called The Men Who Built America. And a book I always try to read as well called Big. I found out that this Christmas break, I was actually very restless. I couldn't watch the documentary. I couldn't read the book. And on the 19th of December, Ghana defaulted. And knowing, I have quite a number of clients who have exposure to that, both individuals and institutions. So I just kept wondering, how is 2023 going to be? And even to further complicate matters, I think Chelsea went on a run of 9 or 10 games without a win. And in that period, Arsenal kept winning, and even Manchester United kept winning. So it was a pretty, sometimes, I don't want to say nasty Christmas break because the family was around, but it was in a long time. Having said that, though, with some of the things I've heard this evening, this from Jerry and his colleagues in the research team, and then from the panel, different sectors, very well diversified, Ini from First Bank, and then Ishmael, and of course Sadiq from Flannels, and Ishmael from MTN. I think 2023 is beginning to look a bit more reassuring. I think I'm seeing some hope, and I think everyone should leave here today feeling the same way. We don't know how it's going to be, obviously, between now and February, March. What we know is that we have 3 or 4 frontline candidates, and many people don't actually know. Even the 4th candidate is quite a strong candidate, and if you see his resume, that's cool. And so he's pretty a good candidate as well. And the other 3 candidates, APC, PDP, and Labour. I think what we know is that by the end of the election, we should be a place as a country, much better leadership. We will get the political will to take some of the big decisions. Petrol subsidy, the FX subsidy, foreign exchange rate system, or however I want to describe it. Those 2 things are very big. One is a 6 trillion naira cost to the economy or to the government. One is maybe 3 or 4 trillion naira loss in revenue. When you put all of that together, some of the things that were actually worrying a number of people I can say that we have a good chance of actually having something exciting out of 2023. I think leadership obviously is going to be better than where we're coming from. We will urge each and every one of you to prepare for the better times that are coming. And just in closing, I would like to thank the panel again for making our time from their very busy schedule to be here with us. These are extremely, extremely busy guys. So thank you very much, Ishmael. Thank you, Ini, and thank you, Sadiq, and thank you, Prof. Also, I'd like to thank my colleagues who put this together. It was a committee led by Philip. Thank you very much, Philip. And it's quite a big committee. I wouldn't be able to run through all the names, but thank you guys for the fantastic job you've done today. And I'd also like to thank each and every one of you in the room for coming to spend your evening with us. I know you are all extremely busy people. We truly appreciate your time. And then, of course, we have several hundreds of people who are with us online. We also want to thank you very much, and we hope that
you've gotten one or two things from this session that will aid your investing activity in the course of the year. Thank you, everyone. And I think the networking sessions will continue after.
As Megan said, we encourage everyone to join us for cocktails and finger foods right after this outside. Please let's interact. If you don't have to rush home, please join us for that. Again, we want to thank those who have joined us online. We hope you found this very valuable. We thank you also for your contributions and best wishes in 2023. Let's get to it. I also echo Michael's sentiment. I also feel more optimistic. I think it can get worse. So, well, it can, but I don't think it will. Thank you so much. By the way, with music.
Thank you.